Let's start with the diminishing balance method. What is the meaning of diminishing balance method and how we calculate depreciation using this method? We are going to understand it with the help of an example. Remember, whenever we are asked to calculate depreciation using this method, we are provided with the following information. Number one, is cost of the non-current asset. Second one is rate of depreciation. Third one is the method, means the name of the method will be given to you, that is diminishing balance method. Okay, and number four is the basis or the policy. These four things will be provided to you if the examiner or the author wants you to calculate depreciation using this method. Okay, now let's see an example. Let's suppose the cost of machinery is $20,000. The rate of depreciation is, let's assume, 50%, and you bought it on let's suppose July 1st 20x2, and basis or policy is you charge, the business charges depreciation, full year depreciation in the year of purchase, and no depreciation in the year of sales. Let's suppose it was sold on November 30th 20x5. Let's suppose. Require calculate depreciation for 20x2, 20x3, 20x4 and 20x5. Let's suppose this is the requirement. Now we will see how to attempt this question. Okay, solution. Okay, what is the cost of the machinery? That is $20,000. For first year, depreciation expense for 20x1. We are not going to calculate depreciation here as we were doing in case of the straight line method. Over there we were calculating the annual depreciation first, and then after that for the specific year for which the depreciation was required to be calculated, we used to use the basis or the policy. Here we are going to calculate the depreciation directly for that specific year following the policy. See, the 50% of depreciation this is the rate of depreciation. It was bought on July, but the policy is that you charge full year depreciation. That means you in the year of purchase, and no depreciation in the year of sale. That means when we sold it out, we will charge no depreciation for year 2020x5, while we will charge full year depreciation in year 20x2. Okay, because this is the basis or this is the policy. So for 20x1 we will apply this percentage, okay, on 20,000. Simply 20,000 we will apply the percentage. We will not give any consideration to the number of months because of the basis, that we don't that we charge full year depreciation in the year of purchase. So the 50% of 20,000 is $10,000. Okay, now the remaining value is $10,000. That is called book value. Okay, we can also call it net book value. When we subtract the depreciation which we have charged on this non-current asset up till now, that is the remaining value is called, when we subtract it from the cost, the resultant is called net book value. Okay, now depreciation, sorry, this was year for year 20x2. We bought it in year 20x2. Now we will calculate depreciation for depreciation expense for 20x3. Now we will apply percentage on this amount. Okay, now we will apply this percentage on the net book value. This is the difference between the straight line method and net book and reducing balance method. In straight line method, we apply percentage on cost every year to calculate annual depreciation, while we apply rate of depreciation in the first year on cost, however in the later years on the remaining value. So now 50% of 10,000, and which 10,000? This is this 10,000. Okay, so what is the value? What is the answer? The answer is $5,000. Okay, that is 50% of this 10,000. This is the depreciation for year 20x3. Now what is the remaining value? The remaining value is 5,000. Now in year 20x4, less depreciation expense for 20x4, how much is that? We will apply this percentage 50% on 5,000. Which 5,000? This is this 5,000. Okay, this is this 5,000. So what is the answer? The answer is $2,500. 50% of 5,000. So the remaining value is 2,500. Again, this is called net book value. Here, yes, the same net book value. So you will see here that in the first year we apply the rate of depreciation on the cost. However, in the later years, in all the following years, we are applying this rate of depreciation on the remaining value, on the net book value. Okay, not on the cost. And this is the difference between SLM and reducing balance method, and this is the only difference. There is only one difference between both the methods. Okay, and that is this difference. What about depreciation for 20x5? No depreciation for year 20x5. Why? The reason is that the policy or the basis is that you charge no depreciation in the year of sales. So you sold it out on, this was the basis, and here they are mentioning you that you are selling it out on November 30th, 2005. That's why there will be no depreciation for 20x5. Have you got it? So this is reducing balance method. Now we see it graphically. First year we are charging depreciation 10,000, next year 5,000, and the third year 2,500. Let's see, let's plot these figures, this depreciation on the graph. First year, this is our first year. Okay, this is 10,000, and the second year, this is 5,000. Okay, then it is 2,500. On second year, it is 5,000, and the third year it is 2,500. So if you join all these points, this will be like that. Okay, so you may say it's a falling curve. It is showing that every year the amount of depreciation is falling, it is reducing. That is why it is called reducing balance method. So the annual depreciation line will always be a falling curve in case of the reducing balance method, while in case of the SLM it will be, in case of the SLM it would be, how was it? It was like that. Okay, and the years were here. So this is all about reducing balance method. Now the question is that for which kind of the assets do we use this method? Remember that we use this method for those assets which give you more benefit in their earlier years of life. For example, your computer, your machinery, plant and machinery, these assets give you the benefit in more of the benefit in the early years as compared to the later years. You know, their efficiencies, they work with their full efficiency and productivity in the early years, while in the later years their efficiency is expected to go down. That's why what is there with, you know, that there is an accounting concept that is called matching concept. The matching concept says that you should take into account all those expenses which have helped you generating income. And since this benefit, and in other words, we can say that the expenses and the income of a particular year should be matched together. Since this asset, this non-current asset, is giving you more benefits in the early years, that's why there should be more depreciation in the early years. And using it, the efficiency is coming down, its benefit to you, to the business, is coming down. That's why the depreciation you are charging is also falling. Okay, this is in accordance with the matching concept. The matching concept asks us to do so. So this method is very much useful for plant and machinery and technological products like computers, etc. Okay. Now after that we are going to attempt another exercise, or we'll say another example. Beta company bought a machine costed $20,000 on April 1st, 20x1. The business charges depreciation using RBM, reducing balance method, at the rate of 20% on proportional basis. So here you may see that all the information has been provided to you. The cost is given. This is cost. Second thing is rate of depreciation. It has been given. Third is name of the method is given. And the fourth one is the policy or the basis is given. All these four things have been given. That's now you can easily calculate depreciation for the years. For year 20x1, 20x2, and for year 20x3, you have to calculate depreciation. Since the policy is proportional, that means we will have to give consideration to the number of months. Okay. So now let's take the cost first. This is the cost of the machinery. In year 20x1, we are going to carry out the working first. The first year, you know, the cost is 20,000. You are applying the percentage. Now the answer is 4,000. But for this year, for this specific year, that is 20x1, you will proportionate it, because this is the policy. You used it for 9 months, from April 1st till December 31st. That's why for 9 months the depreciation would be $3,000. Got it? The simple procedure: apply the percentage on cost. In the first year, we know that in the first year we apply percentage on the cost, and the second, and now in the years to come, we apply percentage on the remaining values. That is called net book value. So in the first year, you are applying this percentage on cost. The answer is 4,000, but you are calculating for 9 months. Why? Because the policy is asking you to do so. So the answer is 3,000. What about in year 20x2? 20x2, you are charging full year depreciation. Why full year? Why you not giving any? Why you are not thinking about number of months? The reason is that you have used it for the whole of the year. In year 20x3, you are selling it out. Okay, so that means this machinery was with us for the whole year in year 20x2. So we are now calculating depreciation for year 20x2, and simply what we will do, we will apply this percentage on this 17,000. Okay, this is 17,000, and you are applying percentage 20% on that. The answer is 3,400, and the remaining value is 13,600. You are subtracting 3,400 from 17,000. The answer is 13,600. This is your net book value. Now in the next year you are going to charge depreciation for how many months? For the number of months you have used it. You have used it for when did you sell it? Machine was sold on March 31st. That means you used it for only 3 months. That's why now you are applying percentage on 3,600. You may see here 13,600. The rate of depreciation is 20%. The annual depreciation in the depreciation for year 2023 becomes 2720. However, you use it only for 3 months. That is why the depreciation for year 2023 is 680. So you have taken 680 here. The remaining value or the net book value at the end of year 20x3 is $12,920. Okay, so we have seen another example here. Now this was all about reducing balance method.